It's highly unlikely that in SBR you'll be asked to illustrate all 5 steps of revenue recognition. No, SBR tests your application of the standard to the scenario and usually just parts of the standard. So when we're talking about revenue recognition, we talked about the first steps. Now let's talk about the last one, when revenue is recognized. And there are only 3 cases when revenue is recognized over time, and sometimes you are asked to challenge if this scenario is one of these 3 cases. I would remind you, revenue can be recognized over time, meaning that I will not have to wait till the completion of the project. I will recognize revenue ahead of it when the benefits are provided and consumed at the same time, when the company creates or enhances the asset that is controlled by the customer. So, for example, when the company made some remodeling of the house that the customer owns, and the company's performance does not create an asset that has an alternative use to the company. Why? Well, because we understand that there is substance over form, and if the company agreed to engage into some project that will produce something that the company will not be able to resell to someone else, then the contracts and the relationship envisage that the company is going to get the consideration. But we are going to recognize revenue only if the entity has enforceable right to payment for the work completed to date. There are other examples that are in line with the IFRS 15 recognition steps, the 5 steps of the recognition of revenue, but they kind of give you ideas of what else can happen in the world. So, for example, sometimes you will be asked to challenge warranties, because by default, if we sell something and we have this contract that says that we will provide free fixes for, let's say, a year, then as soon as we sell something, we need to recognize a provision, debit P&L, credit provision, it's a liability, for the expected amount. Quite often we will use probabilities. And that would be if that is something that is default in the contract. But a customer can purchase the warranty separately. So you will need to explain that this is a separate performance obligation. And in this case, it's going to be recognized as revenue. So the company is going to pay you cash. It's going to be debit cash and credit contract liability, because for this very contract, you kind of need to provide this insurance. We don't call it insurance, but we understand that there will be some works that will be needed on extra fixes of the product, maybe outside of the time of the normal warranty. Quite often, you are tested on consignment agreements. So in this very case, we are going to look at the scenario and we are going to try and determine the risks and rewards, where the company will have to recognize the revenue based on the price of whatever it sells, or the difference between the price and the cost, meaning the commission that they leave to themselves. And for example, if we have a car dealer, then on a normal day, the car dealer does not really suffer from cars being unsold, because they will not have to pay for the cost of those cars. They're just going to send them back to the manufacturer and say, well, sorry. So this means that they will not recognize the revenue based on the price of the car. Instead, they are going to recognize revenue based on the difference between the price and the cost that they will have to substitute to the manufacturer. And we know that SBR likes to test something that was not there in financial reporting exam. So this means that contract modifications are tested quite often. So, for example, if a company would supply some items at one price and then they would modify the contract or sign an additional contract and the price would be different. In this case, we would need to look at the price for these distinct goods and services, and we will need to compare it with the standalone market price at this very date. And if it is the same, then we say, oh, okay, so this contract is going to start when the first one is finished. So we continue using the old price. But if it is not at the standalone selling price, and we say neither of the parties is stupid, and substance over form means that there is some strings attached. So this means that at this modification date, we will terminate the old contract, not legally of course, but in our revenue recognition process, recalculate the remaining revenue to be recognized and the extra revenue according to the modification, and recalculate the new price per item, and that is going to be the price that we're going to use. And it doesn't really matter whether the price is above the standalone price on that very day or below. So, as you can see, it's not really about the 5 steps, right? It is about the logics of substance over form, of consideration being probable, of the control and such risks and rewards being transferred. And that is how IFRS 15 will be tested.